Do you know what I think of when I see this headline? This was released today, January 27th, 2026 by the Wall Street Journal. Now, it's showing the dollar index chart, how it's been on a continuous and persistent downtrend as of recently. Dollar index chart, to keep it as simple as possible, if the dollar index chart is going up, it means the strength of the US dollar is strong. So your purchasing power per US dollar is strong. That means less inflation because every dollar goes a longer way and more purchasing power for the consumer. That's when you start hearing things like cash is king, hold on to cash is holding value relative to other assets such as stocks or other world currencies. Now on the flip side, if this dollar index chart is going down, it means the strength of the US dollar or the purchasing power of the US dollar is going down. What does that mean? High inflation, because your dollar's purchasing power is less now. So your dollar isn't going that extra way. So you need more dollars to purchase the same products or to purchase the same services that you used to be able to when the dollar index chart was higher. So it's very interesting that this is coming out today because this already proved our thesis. We're entering a new monetary landscape and a different monetary cycle. And I would like it to be known for our clients. Our thesis was coming to the end of 2025, the Federal Reserve confirmed that they're stopping quantitative tightening, which means they're stopping pulling liquidity out of the system. That's already a positive and dovish sign. On top of that, they're on the dovish cycle of the interest rate curve. So we are seeing interest rates trending down. We may see a couple of pauses in the upcoming Fed meetings. However, ultimately, within the next year, within the next 2-3 years, we will see interest rates lower than they are today. That's crucial. On top of that, quantitative easing will start to ramp up, accelerate, and persist. And all these telltale signs are telling us that the US dollar will not have the strength like it used to have. And it will continue to drop, maybe not as sharply as it has recently, but it will continue to stay low. We're seeing this in stock prices. We're seeing this in other asset prices. How do you position yourself when it comes to this situation? Whenever you see cash starting to lose its value and lose its purchasing power, you want to have as little cash as possible. So going back to the original question, do you know what I think of when I see this headline? I think I want to have no money in the bank. Now, of course, that's a bit of an exaggeration. Obviously, you want to have some cash reserves for opportunities, for bills, etc. But what I'm really trying to say is position yourself and your investment strategies to be in the most advantageous spot as possible while we're entering into this new monetary landscape. So when I say I want to have little to no cash, I mean not to go spend it on liabilities like cars, materialistic objects. I mean buy assets. Particularly quality real estate. I think right now real estate has a fantastic opportunity. It's not too late. It's not too early. We're right at that sweet spot Goldilocks window to be purchasing real estate like there's no tomorrow if you have the means to do so. Stocks are at an all-time high. I would purchase stocks right now, but I just see better opportunities in real estate than stocks. The fact that stocks are mostly at an all-time high right now, S&P 500 has hit an all-time high. There's still gains to be made there. I'm not saying that the stock market has peaked. I'm saying that the opportunity in real estate is truly something that should be grabbing your attention right now. Now here are the tailwinds. Interest rates are going to be coming down. The Federal Reserve is starting quantitative easing, which means they're pumping more liquidity into the system. They're purchasing government bonds. When government bonds get purchased, demand goes up for the bond, prices go up for the bond. What happens? Bond yields come down. It's an inverse relationship. When bond yields come down, all the interest rates come down. The government bond yields are basically a baseline for interest rates in the United States. Let me explain. If the government bond yields are at 3% right now, that's a 3% that's basically guaranteed, backed by the United States government. Now, when it comes to getting a mortgage, let's say when it comes to getting a mortgage, let's say you want to get a mortgage. The mortgage is not going to give you anything under 3% if government yields are at 3%. Why? Because why would they give you a rate that's under 3% if you're a higher risk than the United States government, which is just a stable, guaranteed source of investment or yield? So once the US government yields start to come down, that's that baseline. Now banks start to lower their standards. So the argument may come up of why not wait for the interest rates to fall down? If they're going to fall down in a year, in 2 years, I'm just going to buy when interest rates are already low. Here's the negative side to that. When it comes to financial markets or asset prices in general, prices fluctuate simply based off of demand and supply. Now, what happens when interest rates come down? Demand is going to rocket ship up, and that's already going to drive the prices up. It's going to be a seller's market at that point, and and prices are already going to be hiked up. This is what we call being priced in. Currently, all these tailwinds are not fully priced into the real estate market. We're still in a buyer's market at the moment. However, I do not think this is going to last a very, very long time. I would be looking at cities that have high demand, that have proven demand, that continue to see potential, have good schools, quality construction areas, good traffic, and so on. South Florida is absolutely fantastic for this. Davie, Florida, still parts of Miami. Now, purchasing now, sure, you're going to be getting mortgage rates still a little bit high compared to what we're going to see a year, 2 years from now. However, you're going to be entering in earlier when all of this is not already priced in. And then in a year, in 2 years, when interest rates come down, asset prices start to rise up, guess what? You got in before all of this was priced into and baked into these asset prices already. You will have thanked yourself for getting in at this time. You can always refinance to lower that mortgage rate, and you'll have secured yourself a fantastic piece of property. Whether it's commercial, whether it's residential, you can never go wrong with real estate. And I wanted to inform everyone of what's going on right now and what my thoughts are for myself as well as for our valued clients. Thank you very much for watching. Stay safe, make smart choices, and invest in real estate.